Morning, everyone. As Andrew said, I'm Michelle. I'm a partner at CMS in London. I've got a keen interest in hotels and leisure and other aspects of operational real estate, and I'm going to be your moderator for this session this morning. As you'll all know, to boost returns, real estate investors are increasingly getting involved in property and business operations. And so at this session, we're going to be looking at capital providers' attitudes to operational real estate. And the four key questions that we're going to consider are whether the service living sectors, which have attracted the most interest from investors over the past few years, beating the traditional segments of office, retail and industrial, and whether that can continue. We're going to look at whether operational real estate is inherently more risky than other asset classes. We're going to look at whether yields need to move out and leverage be lower. And we're going to look at in-house operating platforms versus the alternatives. And as Andrew said, of course, operational real estate is a lot wider than just hotels. So we're going to be looking at other asset classes as well. But first, before we do that, let's have some introductions. Lorna, do you want to introduce yourself?
Morning, I'm Lorna Brown. I'm the founder and chief executive of Birchwood Real Estate Capital, an alternative lender that was established 2 years ago to provide financing into the real estate industry.
Thank you. Niamh?
Niamh O'Connor. I'm a partner at Summix Capital. We are a UK and Ireland-based planning specialist operating in mixed-use urban regeneration and new settlement delivery.
Thank you, Niamh. John?
Hi, John Brockman. I'm with Harrison Street, which is a large real estate investment fund manager focusing exclusively on alternative sectors. The company was founded in 2005 out of Chicago, and we've been operating in the UK for the last 10 years. I've got 17 years of experience in sort of the real estate investment management space.
Brilliant, thank you, John. And last but not least, Irina.
Hi, I'm Irina Stamaterosha. I'm a partner at Patron Capital. It's a pan-European value-add investor. We invest in a variety of traditional real estate classes as well as alternatives. I personally focus on mainly two sectors. One is the healthcare sector, and the other one, education, which includes student housing as well as schools.
Thanks, Irina. So, Niamh, kicking off with you. And looking at the first question, so the service living sectors have attracted the most interest from investors over the past few years. Can this continue? Can it continue to beat the traditional segments of office, retail and industrial?
I absolutely think they can, and I think going back to what you said in your introduction, it's about value boosting. Just to be slightly contrarian, I'm actually going to talk about the rural piece rather than the urban piece, because I think a lot of us are delivering these types of asset classes, operational real estate, into the urban environment. But as we know from the election manifestos of the various parties, but in particular if we consider that it feels like there's going to be a Labour majority next week, we understand that new towns are going to form a big part of what they're wanting to do to deliver housing growth. As an investor into real estate in the rural environment, I need to know that absorption rates from traditional asset classes can take a long time, whereas we're trying to build communities, we're trying to build new towns, and the absorption rates of co-living alongside retirement living, alongside build-to-rent, from a multifamily and a single-family perspective, are delivering these communities much quicker, which is able to generate the returns that we need much quicker. So from our perspective, the supply-demand fundamentals are there. We have very, very significant amounts of data, which I think helps all of our underwriting processes in an operational real estate perspective. But I think there's absolutely growth.
Thank you. And John, I think you've got some views of different asset classes with different risk profiles.
Yeah, so I think Harrison Street traditionally is focused on, again, alternative asset classes. Again, living right now for us is a main focus between BTR, student housing, and also senior living. Senior living was a massive focus for us in the United States, and we've not yet brought the strategy or invested in the strategy in UK and Europe yet. But I think for us, the risks around the sectors are I think the question might be, is it riskier in these asset classes than in traditional asset classes. They are more operationally intensive, and I think you're more aligned to the quality of the operator and what they can bring to the table. But I think based on, as Niamh just indicated, on the fundamental trends that are underlying and supporting these sectors, I wouldn't say that they're necessarily more risky. And in fact, in some cases, I would say right now they're a lot more stable than you'd find in both retail, industrial, office, which have gone through a bit of a fundamental phase shift and paradigm shift as a result of not only the pandemic, but then the sort of behaviors that have evolved after that. So I guess my view is that, no, they're not inherently more risky, but I do think there's a different pool of risks that you need to manage, in how you manage those investments around who are you aligning yourself with from an operational perspective. And again, we focus traditionally on allocating into JVs, and so we're majority equity in JVs with minority partners who are then responsible for delivering business plans. And we support our partnerships in a lot of different ways. So for us, it's about who's most astute in the space to deliver a business plan, quality of care, type of product type, right? Making sure that rents sort of hit affordability criteria that we know we can deliver a business plan. So in short, no, I do not think they're more risky, but I do think there's probably a different angle on the risk that you need to manage to successfully achieve investment returns.
And I think there's ways in which people can manage risk. I think we're seeing a lot more of mixed-use developments as well. So, when you're looking at, for example, hotel-branded apartments, previously they were largely in resorts, but there's a lot more of hotel-branded residential. We've seen a lot of that in the Middle East coming over from Asia, but it's super popular and tends to be on the luxury end, but we are seeing less luxury options available. So there's Uncle are doing something like that, and then completely on the other end of the scale, you've got Raffles and the Ritz-Carlton and so on. And with those, then you've got the challenges to how to keep them up to date, because if you've got brand standards, these are things which are used day in, day out, and how do you keep them up to date? It's going to be more capex and so on. So whilst mixed use, where you've got hotels with the flexibility that you can then use some of the, say, service departments when you need more space, if they're not being used, that can help with your risk, then actually there can be more cost involved.
I was actually just to follow up on that. We don't focus specifically on hotels, so I don't know if any of the panelists have some views on hotels within the context of the question you asked. I mean, that obviously has a different set of fundamental drivers to it than sort of the other sort of needs-based asset classes. So that might be a slightly different twist on the answer I just gave. I don't know if there's...
I'd agree. I think I was we think about it as, is it discretionary real estate, which I'd probably put hotels and travel and those parts in, or is it non-discretionary real estate, which brings you back to pure living? And I think that's, from our side, there's different risk drivers, different risk characteristics attached to them. And obviously we are sitting on the lending side, so we're looking to evaluate all of the points that Niamh and John are talking about in terms of the operating partner and how they deliver. But I think from our side, I don't think that operational real estate is more risky per se, but I do think that it needs different systems and controls, tracking, information, all of those points to really underwrite and therefore evaluate the risk. And I think that is the difference. Traditionally, asset classes, office, retail, etc., have been a very distant relationship between the landlord or owner and the end user. And that separation has been kept there by the real estate industry. And I think what we're doing now is bringing those closer together, because in operational real estate, you need to have much more awareness, knowledge and input.
Flexibility as well.
Exactly, to see what's happening on the ground, how can you adjust it, to really control the costs and be aware of it. So I think those are probably just the factors and drivers that all contribute towards that risk assessment.
Yeah. And Irina, I know you do quite a fair amount in the sort of care homes, student housing, schools and so on. How do you see risk in relation to those?
I mean, I echo what John said. I mean, a lot of investors like it because of the, defensive characteristics, the demand drivers. If you have senior living or, healthcare, you do have, the growth in the elderly population and, that great tsunami that is coming through. But on the other side, you have to really understand each operational real estate sector in quite a lot of detail and spend a lot of time to understand both the regulation, the funding, as well the quality of the operations you're going to buy. Even if you're just investing in the real estate, in the leases, they are intrinsically linked to the value of the operations. So I don't think I mean, I'm a big believer. We have been a big investor in these subsectors, but you would have to think through, I would say, quite a lot of, regulatory challenges and you need quite a lot of specialist knowledge to really, get yourself comfortable that this is the right investment.
And I suppose, the risk is very sector and market specific. So, we have to look at each area separately.
I think on the regulatory challenges, that's a really important thing for us all to be thinking about. We've seen what's happened with rent controls in other jurisdictions. I think also we've seen from a PBSA perspective what happened when the London Plan came out with affordable student, and I think we all need to work harder to be delivering an affordable product. But I think the regions are also going to end up having an affordable student product. We're also seeing that coming. So understanding when we need to put that into our appraisals, I think is something that we all need to really be thinking about. Knee-jerk reactions from from that perspective as well. We've seen moratoriums in certain jurisdictions on certain use classes, certainly on co-living. So I think we need to be better equipped at educating local authorities and senior people at government that there are people out there. I think operational or rental product sometimes seems inferior to a traditional asset class when it shouldn't. People want a higher level of service. People are more transient. They want to be living in these types of buildings, but sometimes it's educating the local authority that co-living, for example, doesn't need to be seen as a negative. It can, bring great positivity to a place.
I think that's right. I'm also seeing that local authorities, when granting planning permission for projects, that they're putting a lot more requirements in for affordability, not even just for housing, as you say, I've seen something recently in relation to hospitality-led workspaces, where they're saying there has to be affordable workspaces within the project, which is obviously challenging in and of itself.
And that's a whole, you could spend the whole panel talking about that affordability point, right? And the challenges against rising costs, rising labor costs, rising housing costs, right? And then how do you deliver then a state-of-the-art product that is sustainable, that end investors would end up wanting? So once you've delivered that product and sold it on, how do you make it compelling for someone to invest back into it for the long term, while also keeping costs down to deliver an affordable rental profile? So I think that's a challenge for all of us sitting here as we go forward in the next couple of years and planning the way that we're investing and how we're investing. That affordability angle is going to be, I think, critically important in all discussions.
Yeah.
It's incumbent on us, though, as well, to be able to deliver that.
Yeah. And then I suppose just turning to our next sort of area about yields, I think, Lorna, it'd be great to hear from you whether you think yields have to move out and leverage be lower.
I think that's probably a question for the entire real estate universe, rather than a question for Opry specifically at the moment. And the reason I'd say that is actually we're in a very different interest rate environment than where we were 2 years ago. That obviously shapes some of the risk return rewards that investors into real estate are looking for. If you can put your money in theory into a bank and now receive a 4% interest rate, if you're going to take more risk on any type of asset, then you need to be paid a premium for that. So I think there is a wash through that needs to come in terms of the wider industry and the risk premium that is attached to real estate. But does operational real estate need a wider premium or a wider than some of the other asset classes? I think that's back to the question we were touching on in terms of, is it discretionary, is it needs-based, what are the supply-demand fundamentals? And in terms of leverage be lower, I think in many ways people talk about leverage as if it's been the sort of the problem child of the part. And actually in many ways in this cycle, I don't think that's really where the problems have come from, in terms of where it's been the sudden change. It's inflation, it is interest rates, as we talked about. It's been liquidity problems within pension funds, for example, that have driven lots of change through this cycle. So leverage coming lower, I think there'll be a natural cap because of where interest rates are, but I don't think those are driven by operational real estate per se. That would just be a real estate-wide and an investment-wide factor.
Thank you. And Irina, I suppose it would be good to hear from you about how you're finding getting debt for some of your projects and assets?
Indeed, we are in the market raising debt because that's one of the levers of our return profile. In most asset classes, we do see generally everything that is living-related students. In every point in the market, we have had very good debt availability of attractive terms. And that is because, of course, of the undersupplied market. And typically, the closer the asset class is to residential, that most people would tend to understand, then it's in favor with the LPs, it's in favor with the banks, the easier it is to get the debt. Where we sometimes have challenges where patrons invest in niches. I would say schools would be one of the niches where we have invested, real estate-backed schools, where the lending universe is smaller. And of course, once the debt availability is lower and the cost is higher, that fits through the yield profile of the acquisitions. So closer to residential, the easier it is, I would say.
I think there's also a size question in terms of what size people are looking for. There's different sources or providers of capital or debt capital coming into the markets now. But if you're looking at things that are slightly smaller, you can have a bank or a lender take that position on their own. If you're looking at very large portfolios now, you may have to bring together a club of lenders, and that can create some more liquidity challenges. But I do think that it's interesting you touch on schools, Irina. That one's one area where there's more political risk probably that people would perceive just now. A question about what will happen with fees, what will happen with business rates. Those are the points that I think are going to sort of probably cause a bit of a pullback in terms of potential debt providers in an area that's probably not as deep as the residential. So I think that's probably a challenge that has to work its way through. But those are political risks that you can't control. So it's just one of those things that people need to wait and see what happens.
And Niamh, to what extent are you seeing things like price chipping as a consequence of leverage?
So for us as an organisation, we're actually unlevered because we acquire land unconditionally, enhance the value through the planning process, and act as a conduit of deal flow to many people in this room of the consented stock when they're not able to take planning risk. So from our perspective, it just wouldn't be sensible to take on leverage. But I think it would be naive of me to say that I'm not impacted by this rates environment, because ultimately John's appraisal is going to take into consideration that. So we're seeing that, there'll be price chips, or if we're not in a binding agreement with somebody, that people, they end up walking if they don't have the ability to be able to even secure the financing, let alone have to deal with the cost of it. But just to change from the kind of pessimistic type of conversation that we're having, I do also see that, we're forecasting that there will be an interest rate drop in the near horizon. And for people that are sitting on dry powder at the moment, I do think it is a buying opportunity, especially in the land space, because by the time you've got planning built and are delivering the product to the market, I think it'll be a much different environment. So if you do, have the dry powder now, I would say that there is an opportunity out there to buy sites.
Well, I would agree. I think leverage right now is a function of the cost of debt, right? And that's going to drive pressure on the cost to deliver a project from a development perspective. So that will put pressure then on land prices and things where Niamh and company are focused. But I think on standing stock and well-placed locations that are either stabilized or stabilizing, the availability of debt right now is actually extremely available. And I think for good opportunities, again, we've seen depth of lender pool coming in for certain opportunities that's been more robust than it has been for 24 months. So there's definitely at the right leverage points, a ton of available debt for within, I think, operational real estate classes, but I would even expand that to most asset classes right now. And again, it's more what can that asset support from an income profile perspective than whether or not you'll be able to find the right kind of debt and match that up. A lot of credit strategies have been raised over the last kind of 24 months, and I think it's become a very crowded space, which has again driven competitive tension into lending processes, because you've got all this money that's been raised around credit strategies now, which are 11 to 13% net returns to investors, but delivering that now after all the space has become again so competitive and crowded is extremely challenging. And when assets aren't trading as often in an environment like today, then you're not seeing as much refinance activity, not seeing as much acquisition activity. So again, I think that's driving a trend towards a lot of available debt capital.
Thanks, John. So turning to operating platforms now, Irina, is having an in-house operating platform preferable to working with an external operator, in your view?
I mean, we like both, of course, but Patron has had experiences either buying or actually building up in-house platforms in care homes, and my other teams in hospitality as well. I would say that we like that for two reasons. One is we feel that we have better control. If something needs to change in the business plan, it's typically much easier when you have your in-house management team, and that feedback loop is shorter. And the other reason for which we like it is, depending on the cycle and valuations in the cycle, sometimes these platforms have value. And it's great to capitalize from that, given that, we'll be incurring costs. That being said, we do work with third-party managers where we don't feel, for example, there's the scale to support the cost of a platform, particularly if you have to do things right. You most of the time have to make sure you have the right people and support quite a high cost base. We then, leverage, the economies of scales of other operators, and we work well in that side. So they both have their pros and cons, I would say. I don't know if John.
Yeah, John, because you don't use opcos, so you have managers, don't you?
Yeah, so historically our business has not invested in opcos, and so I think we've found the flexibility of being able to change out contracts to be a lot less risky from an investment perspective than to be owning, building, and creating your own opcos. With that said, I think that's just because our model, again, is to be allocating it to joint ventures, but we really want to establish the control via alignment with our JV partners. So they'll be developing, managing, and delivering the schemes and business plans. And how they do that is sort of their secret sauce, right? And so there's an element of trust there to say, okay, can that be achieved? And if not, then we have flexibility to make a change at operator, which a lot of times, if we have to do it, we're expertise at doing that and assessing teams to bring that skill set to bear. But I also think if your strategy is different, if it's more of a platform investment versus a large fund structure that's allocating into various asset classes in various jurisdictions, then the focus and control and the concentration of having that expertise in-house can be extremely valuable. And in fact, there is a bit of a trend right now where global capital sources have been purchasing existing management businesses to sort of build their own little platform around it as more of an isolated but standalone business. So again, I think it's capital strategy dependent and again, expertise dependent.
Yeah, we're definitely seeing in the investment fund market that you've got some investment funds with their own in-house capability. So you've got, KKR with Amante and Oaktree with Trinity and so on. But then you've got the converse as well, with Fatal. So, which it is helpful to have that ability for where you've got, for example, flip to franchise options which are being exercised and so on.
I guess I'd be curious from a debt perspective too, Lorna, if you see that, if it matters to you, if it's sort of as an owner-operator model, or if it's more something traditional to the way Harrison Street invests, if that influences the way that you underwrite or review, sponsor for the debt.
I think it's a fair question because it is a structuring question for the lender as much as it's a structuring question for the sponsors. From our perspective, in many ways, it is cleaner to have a separate company. Quite often you might do that anyway, even if it's an in-house platform, but you have a separate company. But the idea then is that there will be a contract, you can understand the terms of that contract, and then you can underwrite the position against it. So I suppose that you're almost creating that outsourced, but you may choose to own the platform in common ownership, but actually under the financing structure, they will almost be treated as two separate parties.
For us, it's different. We actually like dealing with vertically integrated businesses because we're so reliant on our end users to assist with the planning process. And I think local authorities do sometimes like to know who that operator is going to be early on because they want that reputational brand to be there. We need to also know, to help with the planning, the kind of pastoral benefits, if it's student accommodation, for example, that brand and that operator brings. So we do both, but we do find that our life is easier in the planning space when we're working with kind of a long-term, there won't be any change, reputable brand.
Thank you. So I think we've got about 5 minutes left, and so we thought we'd take some questions if there are any.
There's one.
Just one here in the front row.
Oh, hello.
I'll shout if you want. Do you have a fear that everyone is piling into... I think we could sometimes, so I'll carry on. Do you have a fear that everyone is piling into living strategies, that the weight of money there, because everyone, particularly the big funds, are all coming out of office because they're too overexposed to office, to a degree retail as well. It happened in the US, it's happening now in Europe and the UK. And therefore we're going to end up with people taking too much risk. You know, it's very easy to just get, within reason, I'm exaggerating for effect, but it's very easy to go and put up another block of flats here or do this there and so on. You know, hopefully the people with the real expertise will win out and so on, but I'm sure there'll be a lot of people piling in now, just like they did in offices, and get caught with their pants down at some point in the future.
John, why don't you?
I think it increases competition for raising capital for sure. It's a very similar strategy. At the moment, the viability of developments, just with where cost of capital is and where cost of inputs are, it's just very hard to make a scheme deliver as well. So then if you're pivoting your strategy from something that was more oriented to traditional real estate, it's going to take 12 to 24 months at least to set up the right partnerships, get your business plan set up, if you're a developer, find sites that are viable, and to your point, putting them up for competition. So I do think over the medium term, if this continues to be a trend where investment companies, developers that were traditionally focused on traditional asset classes start to pivot and remain in the living space, then yes. I think in the short term, the companies that have established themselves with expertise, with, again, an all-word model, joint venture and development partners who we know, trust, and have alignment with, then in the short term, no. But I think if that does continue, and if there still continues to be headwinds in more traditional asset classes, then yes. To the point, if people are taking too much risk, I think it's kind of been human nature over the last, since economics has existed, for individuals to take too much risk here and there, and I think that is probably inevitable. So then it comes back to your sort of investment thesis, strategy, and your controls as a business to make sure that you're remaining disciplined as you're sort of navigating now a more competitive landscape.
And Lorna, I wonder if you have a perspective.
I think the investable universe isn't as large in residential at the moment, so that pushes people out towards development risk, potentially on those parts, or planning risk, or other areas. And I think the question there is how much knowledge will those investors have? Are they bringing in partners who are already experienced in it, or are they just sort of following the trend? And I think that's probably the point, is exactly as you're going towards, is sort of, are we bringing in experienced investors, or are we having people that are just following the pack? So I think that's the question, because in this type of market, particularly where this is a vintage where people's returns will really come from income when it's in completed stock, rather than from pure capital growth. So if that is the case, then you will need people who know what they're doing and know how to drive value in order to be able to get the upside and not be caught, as we shall say.
But if they do know what they're doing, there is a lot of scope and space for them to play in this market, in this sector. We've been supposed to be delivering 300,000 homes a year. The last 20 years, I think we've been at about 150 to 200,000 homes a year. So that's compounded year after year to leave us in the housing crisis that we're in today. So I think that structural deficit within the living space anyway is there but obviously you need to have the expertise, the skill sets to be able to do it.
Yeah.
Thank you. Any other questions? Tom.
Hang on, Tom. I'll go to you in a minute, Paul. Good morning. To what extent do investors, when looking at operational real estate, need to take into account the social aspects of ESG that aren't necessarily as relevant to traditional asset classes?
So I think Niamh.
Yeah, I mean, enormously so. We're now onboarding LPs such as sovereigns, and historically it was all focused on the E. And I think in our industry we've very easily been able to demonstrate the green sustainable credentials of what we're doing. The S have been more difficult because it's more difficult to quantify social value. But I think through quality placemaking, through social cohesion, by bringing together a lot of these use classes, having retirement living alongside student accommodation and other types of asset classes, are making it easier, but it's understanding how to quantify it. And there definitely is a push from the LP families that we're speaking to and institutions that they want us to be able to quantify the social value and the social gain that these projects bring. I think also we're in a cost of living crisis, so understanding how you can be making more energy efficient schemes, so on the E, that then deliver social value through keeping costs down during a cost of living is also another important way of looking at it.
And John, I think you've been looking at accreditations, or?
Yeah, I think so. the institutional investor landscape now sort of expects you to have certain criteria for your buildings. And so again, when you're delivering projects and looking eventually to sell them on at the end of your business plan, the landscape or the, I guess the mix and the population of institutional investors who will look to buy those investments require certain criteria, right? I think it used to be a feather in the cap to be one of those leading and kind of forward-thinking individuals in that space, but now I think it's a requirement. And to the extent now even that there's, I think, a proven pricing gap between what would now be seen to be sort of ESG, modern ESG credentials. I think we do spend a lot of time on Fitwel certifications. You'll be familiar with LEED in the U.S. And these all fit into these GRESB scores where like fund managers are actually assessed on how much attention they're paying to these things. So it's mission critical to business now, whereas again before 5, 10 years ago it would have been, hey, that's nice to have, and hey, nice to see that you guys are forward thinking, but now it's, I think, imperative.
And on the affordability, maybe I would add that whenever we do our investment cases, we always think about, the product, whatever the market is, not necessarily being at the top of the market, particularly, let's call it student or, healthcare, to have that element of, price point that is not restrictive to the top. We think, one, it's more comfortable, more defensive as a business model, and two, it's great to be looking at something that is more affordable and hitting the S part of the ESG. Sometimes we do that, for example, in student with refurbishment of older properties and making sure that the standards are up to date, yet keeping the price point low. But it is something that it's on the forefront when we do new investment decisions as well.
Thank you. I think we're out of time. We've got time for one more? Hello.
Hi, Paul Slattery from Otis. How long do you expect banks and other capital providers to continue to provide capital for rental projects rather than home ownership?
Lorna?
Sorry, so how long do we expect people to provide capital into the rental sector? I think that it's...
You've had a good run.
Sorry.
You've had a good run.
Yeah, I think it's interesting because, again, it's back to that investable asset class and how big the universe is. I think the interesting part in the UK is the change, particularly from where the housing stock is provided from and whether or not you can institutionalise or have professional landlords in order to provide services and wraparound that make the real estate more operational than purely the delivery of just the house and the product. So I think that I would expect that you will continue to see a trend of capital coming into that sector. It is a non-discretionary, needs-based real estate that provides both a social and an economic function within the UK. So I personally am not sure that I would see a pullback from it, but maybe better placed with the direct sponsors.
Yes, I think, Patron, for example, has been quite active in the build-to-sell market, the normal residential. And of course, we have been looking as well at build-to-rent. To be honest, it's a matter of economics. When the housing market is strong and sale rates and pre-sales are strong, and then we can feel that we can meet our return profiles. Given, the undersupply of housing in UK and other European countries, we really like the build-to-sell market. It's a great market to be. Where it becomes more difficult when, of course, we have an interest rate shocks and there is a question about the affordability and mortgage rates, and then those sales rates drop. But of course, as the economic environment improves, I think the build-to-sell market is as attractive.
Thank you. Great. Well, thank you, everybody. And thank you to our wonderful panelists, Lorna, Niamh, John and Irina.